Dr. Harvey Durham. Harvey, thank you for being here. And most recently, a name some of you might recognize, Dr. Ken Peacock. Thank you for being here, Ken and Roseanne. Welcome home. Now I am pleased to call on Dr. Harry Davis, who will introduce our luncheon speaker. Dr. Davis is Professor of Finance and past Chair of the Department of Finance, Banking, and Insurance in the Walker College of Business. He's also the longtime economist for the North Carolina Bankers Association. Dr. Davis is active in the consulting field and has presented seminars to business groups nationwide. He is a frequent speaker at state, regional, and national banking conventions on economic and banking issues. He has also delivered more executive luncheon speeches for the Boyles Distinguished Lecture Series than any other person. There's a distinction. It is our pleasure to have Dr. Davis here to introduce our luncheon speaker today.
Thank you very much, Chancellor. I know some of you are wondering if I'm actually going to give a luncheon speech today, because I have done it quite a few times, but you're safe. I am not the speaker today. I'm just here to introduce a friend of mine, a guy I've known for quite some time, Mr. Mark Vitner. It's a pleasure for me to introduce him. He talks about the economy in terms that you will understand. And it's not all on this hand, and maybe that doesn't happen, this will happen. I think he'll give a very good talk that you will understand, and you will walk away with some good ideas. Mr. Vitner grew up in Atlanta. He earned his BA at the University of Georgia, MBA at the University of North Florida, and completed further graduate work at the University of Florida. He completed a National Association of Business Economics Advanced Training in Economics program at Carnegie Mellon. He is the managing director and senior economist with Wells Fargo. He's responsible for tracking U.S. and regional economic trends and writes for the company's monthly Economic Outlook report, the weekly economic and financial commentary, and provides regular updates on the housing markets, commercial real estate, and regional economies and inflation. He joined Wachovia, at that time First Union, in 1993, and previously spent 9 years as an economist for Barnett Banks in Jacksonville, Florida. His commentary has been featured in the New York Times, the Wall Street Journal, Bloomberg, and other publications. I've seen him on CNBC. For finance students, you've probably seen him speaking there in the morning. Also on the Carolina Business Review in Charlotte. Would you please join me in welcoming Mark Vitner?
It's great to be here. I love coming up to Boone. I have a cabin up here and don't get here enough. I certainly don't get here enough in October. I mean, it's certainly wonderful out there. I'm going to speak fairly quickly. I'd like to take questions. So think about some questions. There's always a lot going on in the economy. Today's certainly no exception. I took a peek at my iPhone to see where the stock market was, and I never know whether that's a good idea or not. It'll be different by the time it closes, but it is down 290 now. Everybody will look at their iPhones. We've had a lot of days recently where we've had more than 100-point moves in one direction or the other. Now the market's not down that much. We're not there. We're probably around 3.5% or 4% below the all-time high, but there's certainly something that has unnerved the markets, and it's not the U.S. economic outlook. The U.S. economy actually is looking better. We've had stronger job growth. The GDP numbers from the second quarter are pretty strong. Looks like the third quarter was pretty strong. The outlook for the next couple of years looks reasonably good. And the first point, I'll have to see if I can follow through here and look up when I get that. But our first point in kind of our outlook is that we're optimistic. We feel pretty good about the outlook. at least as it pertains to the U.S. economy. What seems to have unnerved the markets is that the global economy is a whole lot weaker than many people had thought. The IMF came out this week and they downgraded their forecast. And for those who follow the markets closely, they know that the IMF, the International Monetary Fund, is a perennially optimistic bunch. They tend to overestimate growth outside of the United States. They don't like the U.S. that much, so they tend to underestimate growth here in the U.S. And true to form, they lowered their global forecast and raised their U.S. forecast. And I think they're still probably too optimistic about growth outside the U.S. and maybe a little too cautious about growth inside the U.S. We've progressed far enough. We're 5 years past the recession that finally many of the temporary measures that were put in place, the emergency measures that were put in place to combat the Great Recession, have been rolled back. Late last year, we ended the emergency unemployment benefits program, and we ended the expanded food stamps program. And the Fed began to wind down their asset purchases, the expansion of their balance sheet, all because the economy had strengthened to the point that those emergency measures, which were put in place in the darkest days of the recession, were no longer needed. And now the Fed's getting there. This month they'll finish. They'll make their last adjustment there. While we're optimistic about the U.S. economy, we're still dealing with some structural issues, and they're all very broad topics that would take a long time to discuss. But you probably heard at least some mention of these. Global rebalancing, where developing economies had been producing far more than they were consuming, and developed economies, particularly the U.S., were consuming far more than they were producing. Well, that's moving into better balance. And here in North Carolina, we've seen some evidence of that where we've seen a lot better news, I should say a lot better, much better news, on the manufacturing front, where we've seen a lot of manufacturers that have been expanding. Even the furniture manufacturing business, is beginning to show a bit of a heartbeat. We've seen some factories reopen, and they don't employ nearly as many people as they used to, but we've seen some positive developments even in the furniture industry. Another thing that's slowing growth that impacts my industry directly is that we're re-regulating. In the 25 years leading up to the financial crisis, we were deregulating. Now we're re-regulating. And I think for most ordinary folks who don't work at a bank, they see that if they go to try to refinance their mortgage. Ben Bernanke became an ordinary person, and he tried to refinance his mortgage, and it didn't go through. He didn't get approved. It's tougher to get a mortgage. When you re-regulate something, you slow it. That's one of the definitions of regulate. And so that's one of the weights that we have on growth. We're still dealing with deleveraging, and we have real issues with inequality. And the inequality issue has really come to the forefront in recent years, really in the past year with Thomas Piketty's book, Capitalism in the 21st Century, have been even more focus on it. And the issues have actually been around for quite some time. And in many ways, they were covered up by they were masked by the housing boom in the last decade. But here in North Carolina, it's played out pretty clearly, and you see the evidence when you drive up from Charlotte. You come up 321, and you look at how Hickory and Lenoir have struggled. And Hickory, and the greater Hickory area is not a huge metropolitan area, and so people don't really follow their economy all that closely around the globe. I follow local economies everywhere, but there's two stats that I think are where the Hickory-Lenoir area stands out. That people, even people who live in this general area, may not have realized. The first one is that in the 2001 recession, the Hickory, Morganton, Lenoir metropolitan area had the largest percentage job loss in the nation, slightly eclipsing the job loss in Silicon Valley. And the unemployment rate in the Hickory area went from 1.7% up to 12%. The other one, which is more recent, is, I can't remember, I'm trying to remember who put the stats together, but they were measuring sprawl. And of all the metropolitan areas in the United States, the metropolitan area that had the worst sprawl was supposedly, I mean by their findings, the Hickory, Morganton, Lenore area. And I thought, well, wait a minute, that doesn't make any sense. It certainly doesn't make any sense. And they're measuring sprawl by how far people were driving to work. And in the case of the Hickory area, what was happening was not that the region was sprawling out, but so many communities in the outlying communities in the rural areas around Hickory had lost so much of their industrial base that growth was sprawling in. People were driving further and further to find work. You see some evidence around that up here in Boone, too, where areas further out from Boone have been very hard hit, whereas Boone has been really an island of relative prosperity in these parts. That same situation, that same condition has been played out throughout a large part of North Carolina. And it's not a recent development. Remember I said this wasn't the 2007 recession. It was the 2001 recession that we were talking about when Hickory had that big fall and never really came back. Well, in the last decade, during the housing boom, we had a lot of growth in construction, and a lot of the people that were displaced, a lot of the workers that were displaced out of manufacturing in smaller towns found jobs either at producers of building products or in the construction industry. And this was mainly true of young men with only a high school education or less than that. And now that construction has been in the doldrums ever since the housing bust, many of those guys have either dropped out of the workforce or had to settle for part-time work elsewhere. That's one of the issues that's driving inequality. It's one of the ways that it comes back closer to home, and it's a real issue for us. And one of the reasons I say that this is something that's going to continue to weigh on growth, and I give it such importance, is I don't see anything being done from a public policy standpoint that's going to improve that. From a public policy standpoint, the greatest thrust of policy is, we need to raise the minimum wage to fix that. That does not fix that. What's driving that is that workers do not have the skills necessary to get higher paying jobs. And so that's a big issue that I don't see going away. All four of those I think are going to weigh on us for quite some time. I don't want to spend too much more time on this broad outline here, but as I mentioned earlier, QE is being wound down. It was going very well. One of the reasons why the Fed decided to taper their asset purchases as opposed to stop cold turkey like they did, the Fed began to, maybe I'll roll back and tell you a little bit about QE. The Fed began QE back in December of 2008. They had taken the federal funds rate down to 0%. And well, the target is 0.25, but it's actually at 0.1%. So they couldn't lower the federal funds rate any lower. They looked at their models, and their models said that they needed to lower the federal funds rate to minus 3% in order to get the economy going. They said, well, we can't go minus 3. That won't work. They said, well, what we can do is that if we drew a line, and usually a yield curve is positively sloping, they said what we could do is that we could buy long-term bonds so they would mimic where they would be if the federal funds rate was minus 3%. And that's essentially what they've been doing with their expansion of their balance sheet. They've been creating money and buying long-term bonds. They've been creating bank reserves. I'll say it correctly because somebody from the Fed will call me. They'll call the IRS and audit my taxes or something. But but they created bank reserves. They've used those to buy long-term bonds. And they've done 3 rounds of it. And when they stopped the first 2 rounds, they stopped cold turkey and all at once, and the stock market promptly dropped 20%. This time they said, well, we don't want to do that because, so what we're going to do is we'll gradually reduce our securities purchases, which is called tapering, is what the word that came out that was used to describe it. And the last reduction would take place this month. And lo and behold, right as they're getting ready to end the program, the stock market seems to be wanting to test their faith again. I don't know whether the market will pull back 20% or not. We haven't had a correction of that magnitude since the QE2 was ended back in 2010 or 2011. So I don't know whether QE will be behind it. What seems to be driving the markets right now is the last point that I have on here, which is worries about the global economy. As I mentioned earlier, the global economy appears to be far weaker than many people realize. And Mario Draghi, who heads the ECB, mentioned this morning that Europe's economy is going nowhere until they have policy reforms put in place. And like many things in public policy, we continue to do the wrong things as long as the markets allow us to. The euro is a failed concept. The concept of the euro currency is a failed concept. It cannot work over the long run. And at some point, there's only two ways the euro can work. If the Germans agree to subsidize the rest of Europe, it'll work. Or if the Germany and the Netherlands leave the euro and go back to their own currency. And nobody likes those two options. They're still trying to find another option. But they can continue to muddle along as they're going now. But Europe's economy is not going to recover until they come up with a sustainable policy on what to do with the euro. Not a small task. The other thing that's beginning to weigh on the global economy is worries about Ebola. And the concern about Ebola, and today there was, I think the UN came out and said there's evidence now that Ebola is beginning to alter economic behavior around the world in a way that's having a measurable impact on economic growth. And I liken my concern about Ebola when it relates to economic growth is you look at what happened with ISIS, and you look at how we were told not to worry about ISIS. Don't worry about ISIS. It's not a big concern. And then 3 or 4 months later, it blew up into something really big. I don't know that the same thing will happen with Ebola, but it seems to be going along that same course. And if you look, we're watching the financial markets all day as well as watching the economy. You can see the reactions to the markets when there's more negative news on Ebola. It is a factor that's impacting the financial markets today. I don't know that it's impacting the economy, the global economy. The UN was the ones who came out with that number. I don't think it's impacting the U.S. economy in a big way. I mean, I remember when we had the H1N1 scare and everybody was going out and buying tarps and things like that sort. I haven't seen any of that buying yet. I haven't seen, and preppers have their own TV network now, so you would think that it'd be easier to do. I'm going to go through just a couple of charts just to reinforce this and end on a note on North Carolina, and then try to take some questions. And I'm going to bounce around, so I'm going to have to peek over my shoulder to see where we are. This is our forecast for GDP going out the next couple of years. Our outlook for 2015 and 2016 is for 3% GDP growth. And it's not an optimistic forecast relative to other economists. The blue chip consensus will be out on Friday. And I would imagine that we're below the midpoint of the consensus. What's happening here in the U.S. is that we're finally beginning to fire on all cylinders. There have been two sectors that have largely been missing in action: single-family home building and government. In the case of single-family home building, it's just been a very, very painfully slow recovery. And we've been building fewer homes and apartments than the trend growth in households. Household growth hasn't been that strong, though. In the case of government's been contracting. State and local governments have been held back because revenues were weak. Federal government's been dealing with sequestration. Well, more recently, revenues have popped back up. Sequestration has been scaled back. And so government spending should be growing modestly. And that should prove the difference between the 2.2% growth we've averaged over the last 5 years and the closer to 3% growth that we're going to average over the next 2. We also feel that 2015, 2016, just looking at the U.S. economy, will likely prove to be the best 2 years of this decade. In terms of employment growth, I'd mentioned at the start that non-farm employment comes out the first Friday of every month, that the numbers had improved. This past month, the month of September, we added 248,000 jobs. We've had 9 months worth of data. The average gain for the last 9 months is 227,000 jobs. Last year was around 195. So job growth has ramped up a little bit. Now, I am not as blown away by those numbers. I mean, I was we had a traders meeting on Tuesday, and our Treasury trader said that it's the strongest job growth we've had ever. And I was like, not ever. I mean, strongest job growth since we've had since the mid-90s, but it comes after a deep recession. There's one big caveat that I see in there. About half the jobs that we added in September were in industries that tend to employ a lot of part-time workers and pay relatively low wages. Retail trade, restaurants, home health care, and temporary staffing, 120,000 of the 248. And that's been the trend recently. And I have this theory that prior to this year, when we had the emergency unemployment benefits and the expanded healthcare, food stamp benefits, that many people were working off the books. They were working for cash, and with their benefits, the unemployment benefits and food stamps, they were doing better than the jobs that were currently available. When those programs ended, I think a lot of them came back into the workforce and took jobs that were already readily available. We saw this happen in North Carolina 6 months earlier than it did nationally because our extended unemployment benefits ended, federal funding ended 6 months earlier here. So I think a good part of the pickup in job growth does not really reflect that much of a ramp up in the economy. It's just a cautionary note on there. Unemployment fell to 5.9%. But let me show you one other chart here, and then I'm going to flip to to North Carolina. This one's I'd say it's one of my favorites. I think it's one of the more telling charts that we have. The unemployment rate, it's good news that it's down to 5.9%, but it doesn't tell us as much about the economy as it used to. It's no secret that a large proportion of the jobs that we've added have been relatively low paying, and a lot of them have been part-time. The absolute number of jobs that exist in the economy is higher today than it was prior to the recession. And more people are working. 1.1 million more people are working today than when we went into recession. We went into recession December of 2007. Well, there's 15 more million people here in the United States than there were in December of 2007. So there are more people. But when you break it out between full-time and part-time jobs, the area that's in blue there is part-time jobs. And part-time jobs are currently 1.1, actually I think I used the wrong number for the total numbers above, but part-time jobs, full-time jobs, so look at the bottom of this, so a better way to put it. We're 1.1 million total jobs above where we were prior to the recession. But in terms of full-time jobs, we're 2.6 million full-time jobs below where we were. And other than this recession, which was about 2.5 times worse than your typical recession, the loss in full-time jobs, the gap in full-time employment from where we are today, from where we were prior to the recession, is as bad as any previous recession we've ever been in. And this is why so many people, even today, with the unemployment rate dropping from 10.1 to 5.9, are still reluctant to buy into the idea that we've had a meaningful recovery, because we're still 2.6 million full-time jobs shy of where we were prior to the recession. So we have the difference, that 3.5 million is how many more part-time jobs we have. One other quick chart just to take a look at. This is the Fed's balance sheet. The bottom is treasuries, the blue is mortgage-backed securities, the other color is other assets. The line on that is the S&P 500. And you can see the 3 steps where the Fed's balance sheet was expanded and how stocks pulled back when each one of those, when the program was ended each time. I'm going to flip forward to I'll talk about this. This gives you a comparison of how North Carolina has done relative to other states in terms of GDP growth. And we were a late comer into the recovery. But over the last year, using comparable numbers, the U.S. economy grew 1.8%. In 2013, North Carolina grew 2.3%. So we grew faster than the nation. We began to see job growth pick up in a pretty significant way. Over the last year, we've added jobs at a pace about 0.5 percentage point faster than the nation. We should add about 80,000 jobs this year. When you look at what's happening in the tech sector, one of the reasons that we got a slow start is that a good part of our tech sector, our expertise, is in communications equipment, which I started with a good bit about Hickory. Not only did they get walloped because the furniture tanked after China came on board, but the communications sector there, we made a lot of communications equipment, it got walloped as well. The growth in tech was not in areas that we had a lot of expertise in North Carolina. It was mobile communications, it was social media, it still is, internet security, and it took longer for us to benefit from those trends than some other markets. In terms of population growth, one of the things that really helped drive the state is that we've had lots of folks moving to North Carolina from other states, and we haven't seen much of that since the Great Recession. Since it's tougher for folks to sell their homes in other parts of the country, population growth into the state has slowed. Of the population growth that we've had, and we added close to 100,000 people in 2013, 80% of that growth occurred in Charlotte and Raleigh. If you go back to the 1980s, only 40% of the state's growth occurred in those markets. I think I may have gone on too long, so let me stop there. I'm certain that when John was here previously, he probably told you how to get our stuff. If you're not getting it, you can go to wellsfargo.com/economics, and there's a link on here as well as to how you can sign up and receive our emails. So let me stop there, and if I've got some time, I'd love to take some questions. I'll repeat it to you. West Virginia? Yeah. What you see in this chart is the states that have the strongest growth are in gray, and the energy states, the states that really were benefiting from the shale boom. And even though West Virginia is a coal state, they also are benefiting from the shale boom in a big way, and that's what's driving their GDP. So it's energy states and also some technology states. And I think Colorado stands out too because they got the wacky tobacco. Now they've got energy and technology there, plus the wacky tobacco. So, any other questions? Golly, I hope I didn't depress you guys. But you do have a credit union guy coming up, so yeah. Yeah, that's a tough question, and it's a good one to end it on. But what's the most important thing that state government can do from a public policy standpoint to help us be competitive? And there are a number of things that you can do. I mean, and I tell you, let me tell you from a federal level too, because it's pretty simple. We need to fix the tax code on a federal basis. The last time that we really fixed the tax code, that we updated the tax code, was in 1986. We've tinkered with it some since then. In 1986, the Berlin Wall was still up. The internet was under wraps. Nobody knew about it. It's a different world. You couldn't move your company to Ireland for tax reasons because it was tough to imagine to run it from Ireland. But now you can do that very, very easily. We need a modern tax code. We need to fix immigration policy. And we need to fix education. And so, and those two are very much related because our secondary schools are not graduating enough people trained in the things that they need to be trained in order to take the jobs that are being created. And quite frankly, even higher education, we're graduating too few people with the right skills, which is why so many college graduates are having having trouble finding work. We've made up for that by having an immigration policy that brought highly skilled immigrants into the country that have filled a lot of jobs in technology. There's some research that's done by UC Berkeley that showed that for every job that's created in the tech sector or in the innovative sector, innovative parts of the economy, that it had an unbelievably high multiplier of 5, that it generated 5 jobs in other parts of the economy. I don't buy that multiplier, but even if you cut it in half, it's bigger than anything else we've got. I mean, manufacturing is like 1/6. And that's made up for it. So we need to fix immigration policy. You look at a company like Facebook, and Facebook is growing rapidly, and they're doing a lot of things. I know some people think, oh, nobody's using Facebook because their parents use Facebook, but you can look at every demographic, and Facebook is the most popular app used, every single demographic. Company's growing like crazy. I don't know whether we bank Facebook or not, hopefully, but when Facebook's looking, when they're hiring engineers now, for their R&D, it's being done in Vancouver. It's not being done in Silicon Valley. Well, they do it in Silicon Valley. They can't get anybody in Silicon Valley. They can't bring the immigrants in, and Canada's got a better immigration policy than we do, so they're expanding in Vancouver. We got to fix that. Well, that's beyond the local level. Those are things that can be fixed at the national level. At the local level, we need to make sure that we're competitive from a tax perspective with our neighboring states. And we've gone a long way toward that. It's a multi-step process under what Governor McCrory did, the legislature did, but we will be competitive. And I think McCrory was well suited for that because he came from Charlotte. And in Charlotte, I did a seminar yesterday on the future of Charlotte, and I talked about the importance of education. And somebody said, Mark, can you give me one example of a community that spent a lot of money on education where it's really paid off for them in economic development? And I said, I don't know if I paid you to come up with that question, but I said, here in Charlotte, you only have to drive 10 miles south to Fort Mill, South Carolina, which is just reeling in the companies left and right to see a community that invested a lot in education and is benefiting from that. That's a challenge for us. And it's a challenge for a lot of parts of the country. Very few school districts get it right, but that's a big one that we've got to get. We got to fix that, and then we've got to figure out. I went around with we did a rural economic development summit in Spruce Pine late last year, and we've got to figure out a way to retrain workers in rural parts of the state, and also to somehow solve the drug issue. Because we had 14 business leaders from the greater Spruce Pine area talking about all the job opportunities they had. And among those 14 companies, there were more jobs available than there were unemployed people in the 2 and 3 counties that made up that area. But they couldn't find workers. And these were very skilled positions. And they all talked about the problem of getting skilled workers. And they said, but honestly, we can't get people to pass the drug test, even the ones that we might be able to train up. We can't get them to pass the drug test. So that's a big issue for us. It's not one that's alone to North Carolina, but it's one that in the rural parts of the state is much worse than I think that many people realize. So hopefully that's I bet that ended on a happy note, but hey, just reinforce that. I'll tell you that I'll end on one happy note, and that is that for all the troubles that we do have, I travel all around the country, and I'm actually I chair the Chamber's Economic Committee, California Chamber's Economic Advisory Committee. So I've got to be an expert on the California economy. They look very enviously at North Carolina. They for all the troubles we have, everybody's got troubles. Everybody's got challenges. The rural parts of California actually have higher poverty rates than the rural parts of North Carolina. They've got drug issues there that would make us envious. So everybody has challenges. Most of the country and much of the world looks at North Carolina as a place that does more things right than other areas, and I think we're in a pretty good competitive position relative to others, and for all the challenges we have, unless the global economy turns out a whole lot weaker than we currently think. The next 2 years ought to be pretty good. Thank you very much.
Thanks, Mark, for your very insightful and comments and putting them in terms that we can all understand, very complex matters that you put in terms that we can all understand. I'm going to go slightly off script now. We do have a presentation to make, and I would like to ask former Chancellor Ken Peacock to come up and assist me with that. I think many of you are aware that Ken Peacock was an instrumental player in establishing this lecture series now in its 54th installment. And so, Ken, if you would come up, and Mark, we'd like you to come back up as well. So I want to tell all of you what is going to be on this crystal tower that we're presenting to Mark. Mark, please accept the crystal tower etched with the university seal and the date of your presentation to the Boyles CEO Lecture Series Luncheon as a commemoration of this event, and it is very heavy.
Thank you, Dean, for giving me this opportunity to come and participate in this presentation. Mark, thank you for your participation and for Wells Fargo and all its support through the years for Appalachian. People look at me and say, I'm surprised to see you here. Look, I'm in a new chapter. This is a free meal. It has dessert, a salad, it's everything. So we always respond to free meals. It's great to be here. It's good to see this. And I thank everyone for the continued support of the Boyles Lecture Series. Edward, thank you. It's very special with your father's name here. Senator Jim Broyhill, thank you for your continued support. You were the one that helped me start it, but the thing that really got it started, it was a rainy day, and you couldn't play golf, and so you would come and help us out. So I remember that quite well. Sometimes the elements just go with you. But thank you all for coming. It's been a great day. I look forward to many more of these in the years to come. Thank you.
Thanks, Ken. Thank you all for being here today. This concludes our luncheon. We do have the lecture that is going to start at 2 o'clock just behind the curtain. We hope you'll be able to join us to hear Jim Blaine's comments, and have a great day. It's beautiful outside, so I'm sure your afternoon will be very pleasant.